Welcome to Talk Tickers. We cut through the noise of earnings calls to bring you the essential insights.
That's right. And today we're diving deep into XPO's most recent financial report.
Yeah, XPO. Our mission today, as always, is to get past those headline numbers.
Exactly. We want to understand what they really mean, especially for anyone, following the market.
So we'll hit the overall performance first and then really drill down into the key drivers.
Sounds like a plan.
Okay, so first glance. First quarter revenue came in at $2 billion.
Mm-hmm.
Now, that's actually a slight dip, about 3% compared to last year.
But sequentially.
But up 2% from the previous quarter. So a bit of a mixed signal there.
Okay.
And profitability.
Right. Adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization, for those keeping score.
Yeah.
$278 million.
Also down slightly year over year.
Yeah, down 3%, matching the revenue dip. But, and this is interesting, their adjusted diluted EPS, earnings per share.
Yeah.
That actually beat expectations, came in at 73 cents. Oh, okay. So better than the street expected on the bottom line.
Exactly.
Now, you mentioned key drivers. What really stood out in the report?
Well, it seems like the LTL segment, Less-Than-Truckload.
Ah, yes, their core.
That really seems to be the story here. It maintained strong momentum, apparently outperformed the wider industry during the quarter.
Okay, so let's unpack that LTL performance then. What were the specifics?
So LTL revenue itself was down 4% compared to Q1 last year.
Mm-hmm.
But like the overall company, it was up 1% sequentially from the previous quarter.
Right. And you often have to strip out fuel surcharges to see the real picture, don't you?
Good point. Yeah, if you exclude fuel surcharge revenue, because, fuel prices jump around.
Yeah, they can skew things.
Right. Excluding fuel, LTL revenue was down only 2% year over year and still up that 1% sequentially.
Okay, so underlying freight revenue holding up a bit better.
Seems like it. But here's maybe the bigger deal. Their LTL adjusted operating ratio.
OR, yeah. Key metric for efficiency. Lower is better.
Exactly. It improved sequentially by 30 basis points, landing at 85.9%.
And 30 basis points sequentially. That's better than you typically expect just from seasonality, isn't it?
That's what they highlighted, yeah. Suggests real underlying strength in how they're running things.
And this isn't just a one-off improvement, is it? I think they mentioned a longer trend.
You got it. They've racked up a cumulative 370 basis point improvement in that adjusted OR over the past 2 years.
Wow, 370 basis points. That's significant. Almost 4% more profit margin purely from operational gains over 2 years.
It really demonstrates a shift, doesn't it? And it's not just cost cutting, it seems.
No. What else is driving it?
Well, their yield, the revenue per shipment has accelerated. Excluding fuel, yield was up a solid 6.9% year over year.
6.9%. And accelerating from the prior quarter, too.
That's right. Suggests they've got some real pricing power, or at least they're managing their mix well.
And how are they achieving that efficiency gain? Any specifics on cost control?
Oh, yeah. A huge factor was purchase transportation costs, when they pay other carriers.
Mm-hmm. Using brokers or other trucking companies.
Exactly. Those costs plummeted, down 53% compared to last year.
53%. That's massive.
It really is. And their use of outsourced line haul miles, that long haul trucking between terminals, hit a record low, only 8.8% of their total miles.
And they think they can push that lower still.
Yeah, they're targeting mid-single digits by the end of this year. That goes straight to the bottom line.
Definitely. What else? Any tech involved?
They mentioned improved labor productivity, attributed it to their own proprietary tech that helps them anticipate volume shifts.
Smart. Using tech to optimize staffing.
Seems like it. Plus, some key service metrics looked good. Damage claims ratio hit a record low, just 0.3%.
Very low. Customers appreciate that.
And they logged their 12th straight quarter of year-over-year improvement in on-time performance.
12 quarters. That's consistency. Those service metrics are crucial for keeping customers happy and justifying price.
Right. And speaking of service, they're seeing benefits from recently opened service centers.
Ah, the network investment's paying off.
Looks like it. Improving service by, reducing rehandles, shortening transit miles.
More efficient routes. Fewer touches on the freight.
And it gives them capacity. They mentioned having around 30% excess door capacity now because of this network expansion.
That gives them room to grow without immediate bottlenecks.
They've also been investing heavily in the fleet itself. Tractors, trailers.
Keeping things modern.
Yeah, since 2021, over 5,000 new tractors, 16,000 trailers, brought the average tractor age down to just 4 years.
That helps with maintenance, fuel efficiency, reliability, all good things.
Definitely. And back on pricing, those strategies seem to be working, driving that yield growth we talked about.
Through contract renewals and new business wins.
Yep. And interestingly, they highlighted local customers and their premium services.
Becoming bigger parts of the mix.
Yeah, and higher margin parts too. They're seeing more demand for things like retail store rollouts, trade show logistics, specialized stuff.
That makes sense. Higher value, less commoditized.
And looking ahead, they're rolling out proprietary AI.
AI. For what specifically?
Line haul optimization, labor planning, pickup and delivery routes, the core operations.
And early results?
Pilots are showing higher load averages, better transit efficiencies, so potentially more gains to come there.
Okay, so a lot going on within LTL. Let's zoom out again to the overall financials for the whole company.
Right. So we mentioned LTL adjusted EBITDA was $250 million, down 2% year over year.
And that dip was due to?
Lower fuel surcharge revenue, mainly, also lower tonnage overall, and some reduced pension income factored in.
Gotcha. But how did the whole company's operating income look?
Actually pretty good. Total company operating income was up 9% year over year to $151 million.
Okay, so positive operating leverage despite the LTL dip.
Seems so. And net income also ticked up by 3% to $69 million. That translates to the diluted EPS of 58 cents on a GAAP basis.
And cash flow, always important.
Generated $142 million from operations, deployed $191 million in net capital expenditures CapEx. So investing heavily.
Right, facilities, that new fleet we talked about.
Exactly.
How's the balance sheet looking after all that? Liquidity, debt.
Seems pretty solid. They ended the quarter with $811 million in liquidity.
Okay, decent cushion.
And their net debt leverage ratio improved, down to 2.5 times trailing adjusted EBITDA.
Down from 2.9 times. So deleveraging a bit, even with investments.
Yeah.
That's good.
Yeah, and they also tidied up their debt structure, repriced some big term loans, refinanced their ABL revolver.
Extending maturities out.
Yep, out to 2030, and secured $600 million in availability there. So stable financial footing.
Okay. And what does this mean for, returning cash to shareholders?
Well, they expect CapEx to moderate going forward. Less spending relative to revenue.
Which should boost free cash flow.
That's the idea. Higher free cash flow this year, giving them flexibility, and they've already acted on that.
How so?
The board authorized a share repurchase program, up to $750 million of common stock.
Wow, $750 million. That's a pretty significant buyback authorization.
It is. They said they expect to start buying back shares opportunistically this year.
Okay, that's definitely a signal of confidence from management.
Now, back to the LTL operating details for a sec. Tonnage trends.
Right. Volume is still key. How did that look?
Total shipments per day were down 5.8% year over year.
Okay, so volume's still under pressure.
Overall, yes. But their local channel, that segment they're focusing on, saw mid to high single-digit growth. So a divergence there.
Interesting. And weight per shipment?
Down slightly, 1.8%. So the combination meant total tonnage per day was down 7.5% year over year.
Still down. But how did that compare to the industry?
They said it outperformed the industry trend, and the trend improved through the quarter. January was down 8.5%, Feb down 8.1%, March only down 6%.
Getting less bad each month. Any read on April?
They estimated April was down about 5.7%, so continued sequential improvement.
Okay, and the yield story held up?
Oh yeah, yield ex fuel up that 6.9% year over year. Revenue per shipment up 5.2%.
And that's 9 straight quarters of sequential improvement on those metrics.
9 consecutive quarters. They expect that momentum to keep going.
Consistency is key. What about Europe? Any update there?
Quick note on Europe. Revenue up 2% year over year on a constant currency basis. Adjusted EBITDA jumped 19% sequentially.
Strong sequential improvement there.
Yeah, and their sales pipeline in Europe grew by high single digits too, so positive signs overseas as well.
Okay, so let's talk outlook. What are they guiding for the rest of the year?
They're sticking to their full year margin improvement target, around 150 basis points for the LTL segment.
Even if tonnage stays negative?
Yeah, even with slightly negative full year tonnage growth assumed. If tonnage is maybe worse, say down mid-single digits for the year,
then
they still think they can get around 100 basis points of margin improvement.
Still decent improvement, even in a tougher volume scenario.
Yeah.
Shows confidence in their cost and pricing actions.
Definitely. And for Q2 specifically, they're expecting another strong quarter for margins.
Better than usual sequential improvement again.
They said they expect to be at or maybe even above the high end of the typical Q2 sequential improvement range, which is normally like 250, 300 basis points better operating ratio.
Okay, so they're guiding for a potentially very strong Q2 margin.
Seems that way. They also said the pricing environment remains constructive.
Meaning they can still get price increases.
Yeah. Their strategy to keep closing the gap with the best-in-class peers involves a few things.
Like
Continued service improvements, obviously, but also increasing accessorial revenue.
extra charges for specific services, right?
Yeah.
Pallet jacks, lift gates.
Exactly. That's currently about 11% of their revenue. They're targeting 15%.
That's a decent chunk.
And continuing to grow that small to medium-sized business segment, SMBs.
Higher margin generally.
Yeah.
Where are they now versus the target?
Currently in the low to mid 20% range of total revenue. The target is 30%.
Still room to grow there. Any other near-term signs?
They mentioned that local channel tonnage growth actually accelerated into double digits in April.
Oh, wow. So that focus area is really picking up steam.
Yeah. And the comparisons get easier in the second half of the year from a volume perspective.
Right. Comps from last year were tougher earlier on.
But there's always a but.
Uh-oh. What's the caution?
They are hearing some more cautious outlooks from customers about demand in the back half of the year.
Okay, so macro uncertainty still lingering.
Seems so. And on tariffs, they haven't seen a big pull forward of demand yet.
Customers still figuring things out.
Yeah, sort of a mix of wait and see, continuing as normal, some pulling forward, some redesigning supply chains. It's varied.
Okay. And any difference between customer types? Retail versus industrial?
Just slightly. They said industrial outperformed retail a bit in Q1 and into April.
Interesting. What about competition? Did they address, say, UPS moving into heavier freight or Amazon's LTL ambitions?
They did. Management basically doesn't see either as a material threat right now.
Why not?
Differences in shipment characteristics, mainly. And XPO's exposure to the specific types of freight those players might target is relatively small, they argue.
Fair enough. And pricing power overall, contract renewals.
They said renewals were up in the mid to high single-digit range.
Strong numbers. Reflects tight capacity and their service quality.
That's the argument. They feel their service justifies it. And they also believe their pricing is still below the top tier when you normalize for things like weight and length of haul.
So, still runway to improve pricing further over time.
That's their view. One last point on spending CapEx.
Right. They said it would moderate.
Yeah. LTL CapEx as a percentage of revenue hit 14.6% in 2024, which included some one-time spending on those new centers and fleet upgrades.
And going forward?
Expected to drop in 2025, moving closer to their long-term target range of 8-12% of revenue.
Okay, so peak spending might be behind them, freeing up that cash flow we talked about.
Exactly. So summing it up, XPO seems to be, executing pretty well.
Mm-hmm. Focusing on that LTL efficiency and profitability, even with the freight market being a bit soft.
Yeah, the investments in tech, the network, they seem to be showing real results.
And management sounds pretty confident about continuing margin expansion. The buyback adds to that confidence signal.
Right. Which brings us to, this is not financial advice.
Our favorite segment. What outrageous but plausible idea have you got simmering today?
Okay, so XPO is laser focused on margins, right? Even if volumes are just okay, they're pushing into higher margin local SMB freight. They've got this new efficient network, big buyback just announced.
Okay, setting the stage.
So here's the thought. What about a pairs trade? Go long XPO because of all these company-specific improvements, and simultaneously short maybe a more traditional national LTL carrier, one that's perhaps more tied to large national accounts, maybe hasn't shown the same agility, the same investment in network modernization recently.
Interesting. So you're betting on XPO's specific strategy outperforming a potentially less nimble competitor while hedging out some of the general market risk.
Kind of, yeah. Capitalize on XPO's execution while protecting against broader industry headwinds that might hit the, let's say, less adaptable players harder.
That's certainly a way to play the divergence we're seeing. Definitely food for thought, not advice.
Absolutely not advice, just an idea sparked by the call.
Well, it definitely paints a picture of a company actively trying to shape its own destiny in a complex market.
Yeah. It leaves you thinking, doesn't it? How will this focus on service, on tech, position them as the freight landscape keeps changing?
A key question indeed.
Definitely something for you to mull over. What stood out to you in this analysis? What are your thoughts on XPO or the freight market in general?
We'd love to hear your perspectives. You can always reach out on platform social media.
Please do. Thanks for tuning in to Talk Tickers.